Good evening, everyone. You guys can talk now. Good evening.
Good evening, sir. We are with you.
Good evening, sir.
Good evening, sir.
Good evening, sir.
Yes, sir. We are waiting, sir.
Apologies
We
for
are
Evening,
with you,
sir.
sir.
line.
Good
Good
evening,
evening,
sir.
sir.
I hope you guys enjoyed your weekend. Sorry
Yes,
for
sir.
Yes, bless God.
to back class. Some of you guys are coming from FR class. So I just dropped a call with you. It was a tough one. Said people are asking many questions, seem to go vacant. Be like, okay, you guys should be fine. All you just have to do is to be consistent, right? And then practice more questions. Ask when you are not clear. So those are the things that you just have to do. So okay, let's get to it. Um, this is PSAF. Our rules and regulation remains the same. You are welcome to Apex. Like I said, the decision to use, please, Mr. Okogo, can you mute yourself? The decision to use any medium for lecture is with the lecturer. So we just actually permit us and accept us this way for this is that we'll be commissioning those mediums. So anyone that lecturer is fine with, that's what we'll be using. So this lecturer for PSAF will be taking you some parts, and he said he would prefer this, right? So and then we are going to get go at it for the next 2 hours. Fine. Um Permit me to introduce to you Mr. Samson or Lasunkwame David. He will be taking us through the investment appraisal topic for public sector accounting and finance tonight. I need your maximum support in terms of decorum and composure. Do not make the class out because I'm going to leave you with this class, right? The class is stream live. Let me share the live stream this thing to the something. Can you start now? Thank you.
Hello, everyone. Good evening.
Confirm if you can share your screen now.
Good evening.
Not yet. I don't have access to share my screen.
How about now?
Still the same thing.
The same thing.
Yes.
Try it now. Let's see.
Okay, I have access now. Thank you.
Okay. So start the class, please. Thank you.
All right, thank you so much. Okay, good evening, everyone, once again. Yeah, my name is Olasu Komin, and I'll be your tutor for today. I'll be taking you guys through investment appraisal in PSAF, and I'll need your maximum support, please. I'll need us to mute our mics. All I need you to just do in today's class is to just listen attentively. Any material I'll be using or any solution I'll be solving tonight, I'm going to try as much as possible to share them after the class. So all you need to do is just to listen, and there'll be time for questions and answers. Thank you so much. Also, please let me know where you can see my comments. Please let me know if you can see my screen.
You cannot see it.
Oh,
We can't see
See your
your screen,
screen.
sir.
okay. How about
Please,
now?
you know.
We can see
We
it. We
can
can
Yes,
see
see
it.
it.
we can see now. We can see
We
now.
can see it
It's
now.
coming up.
You can
All right,
see it,
thank you.
sir.
Yes, I can see.
We can see it.
So it's
Okay,
coming
thank
up.
you.
Okay, showing now.
All right. So, like I said earlier, please, I just need you to listen. So, I'll be taking investment appraisal. As you all know, PSAP is divided into 4 sections. This is the syllabus on my screen. We have the regulatory and conceptual framework. We have the planning and budgeting, which is 20%, report and audit, 30%, and public finance, 30%. So, I'll be
Nothing is
taking you
showing
to,
on your screen.
you can't see my screen like
Sir,
this.
sir,
It's not showing
We
anything.
can see it.
It's showing. You can see it.
We can see it.
Please
Maybe it's from your
continue.
end.
Continue.
Here is my
It's,
next
Please,
question.
it's becoming
maybe it's your
distracting.
It's not
network,
showing
please.
anything.
Continue.
Maybe it's your network, please. So I'll be taking you through public finance, both the written part and the calculation aspects. So for the calculation aspect of the public finance is where we have investment appraiser. So and as you all know, investment appraiser, I believe, is not a new topic to most of you all. I believe you must have come across it in one way or the other. So I believe you'll be familiar with whatever I'll be talking about tonight. So and this is the
Sorry,
material I'll
sir,
be
for
using.
cutting it short. Can you please tell us the page of this investment appraisal in the study guide, in the study pack? Can we know
That's
the page of this topic?
chapter 36, if I'm not mistaken.
Okay, thank you.
Yes. So chapter 36. So it is under public finance. Under public finance, that is where investment appraisal comes in. And it has been an area where ICANN has always been examining in the past exams. So as you all know, investment appraiser, I believe most of you can see my screen right now.
Yes, sir.
All
Yes,
right,
yes,
thank
sir,
you
we
sir,
so
we
can
much.
see
see
your
it.
screen. We can,
So
sir.
we need to be snappy with this written aspect because we try as much as possible to solve probably 4 or 5 questions on this topic tonight.
Yes,
So
we
as we
can.
all know, investment appraiser, what is the meaning of investment appraiser? What comes to your mind when you hear investment appraiser? So I have this summary notes to help us. Sorry, please, few minutes, please. I want to share the YouTube link.
Please continue. I've shared.
All right, thank you. Okay, thank you. So investment appraiser is a technique aimed at finding out the least possible costs of an investment and maximum economic benefits which may accrue from the commitment of resources to it. So in a layman, what does this mean? It's just like saying that this is just like a process of evaluating and analyzing potential profitability and risk associated with an investment project. So the question is, you as an investor, you decided to invest your surplus funds into various projects. You have 5 different projects which you can invest your surplus funds into. But as an investor, you know you need to assess the risk and the reward of each investment. So that is just the layman meaning of investment appraiser. It helps investors to determine whether an investment can be financially viable and aligns with strategic goals. Strategic goals in terms of investor A and investor B. Investor A might be aiming at, okay, my goal on this investment is how soon can I realize the capital I'm investing? Meaning that investor A is looking at the payback period he or she can derive from such investment. One investor B might be saying, okay, what is the maximum profit I can derive from this investment? So the goals of investor A and investor B might be different from each other. So in a nutshell, investment appraisal is just talking about you doing what? Trying to assess the profits and the risk associated
Sharing your
to a
screen.
project. Can you hear me?
Sorry, did you stop sharing your screen?
No, I did not.
Yes, we
Maybe
can
it's from
hear
my
you,
We
side.
sir.
can hear.
And we can see the screen.
All right,
Yeah,
thank you.
continue.
So, in a nutshell, that is the meaning of investment appraisal. So,
I can't see your
that's it.
screen. No, your screen is no longer showing.
It's
The screen
network.
is
It's
showing.
network.
The screen is showing.
From
If your screen
other
is not,
It's
if you're
your
not
network.
seeing it, what
Make
you need to
you
do is
just
to
log
log
out
out
and
and
log
log
in
in.
again.
network is showing.
Please,
It's
is
the
your
network.
network.
Okay, let's
Okay.
continue.
Can you please
Continue,
reshare? Just
continue.
reshare.
Okay, continue, please. So you
There
can
are many
try to
tech.
stop sharing and reshare, but
All
I'm not
right.
also seeing it.
Okay,
Yes,
I've
you
stopped
shall just
sharing.
reshare it again. Can stop showing. Thank you, sir.
How about now?
Yes, it's showing.
It is
Yes,
showing now.
yes, it's showing now.
All right, thank you. So I already explained the meaning of investment appraisal. I believe with my explanation earlier, you should have a brief idea or understanding on what investment appraisal is talking about. So let me proceed. There are many techniques available for the appraisal exercise, which can be classified into discounted cash flow or non-discounted cash flow. And for investment decision in government, we have the cost benefit analysis and cost effectiveness analysis. These are further classified as follows. We have this is just talking about the various methods of investment appraisal that we have, the various techniques of investment appraisal that we have. We have the accounting rate of return, we have the payback period, we have the discounted cash flow, we have the net present value, we have the internal rate of return, we have the profitability index, we have the cost benefit analysis, and lastly, we have the cost effectiveness analysis. So all these methods assess the expected returns, the costs, and the risk associated to a project. So it helps an investor to make decision on which projects to invest in. So I'll be taking each one of them one by one and be explaining them. Accounting rate of return. What is the meaning of accounting rate of return? This is your return on initial outlay or return on your average capital. It is also called return on capital employed. What is the meaning of this grammar here? Accounting rate of return is just like you assessing the profitability of an investment. I'm investing in this project. What will be my returns? What will be my profits on this investment? That is just what accounting rate of return is talking about in a layman language. You're trying to assess your profit on an investment. You're trying to calculate the profit you're going to realize on an investment. That's the meaning of accounting rate of return. And it can be computed using the formula showing on my screen, which is average accounting profit divided by your average investment multiplied by 100/1. And for you to calculate your average accounting profit, there's also a formula for it, which is your total profit divided by the number of periods for the project. And for you to calculate your average investment, it is your initial investment plus any scrap value you'll be having at the end divided by 2. So all this formula you are seeing on my screen, we are going to be putting it into practice by the time we start solving questions. So I believe that's not what I'm trying to explain.
Guys,
Please, someone is talking. Please let us all try to mute our mic, please. Okay, please, if there's anything that is not clear, you can call for help, please. The second technique we have is the payback period. I believe this is self-explanatory, payback period. This method focuses on the time taken by an investment to recoup the amount of money invested in a project. The method focuses only on cash flow rather than profits from the project. The shorter the payback period, the more preferable is the project. It further says a project will be undertaken only if the payback period is shorter or at worst, equal to this maximum set standard period. For a single project, the payback period is compared with a set standard. For mutually exclusive projects, they are ranked, and the one with the shortest payback period is what is selected. So what we are trying to say here is payback period is just talking about the time it's going to take for you as an investor to recover your initial costs into the project. The time that is going to take you to recover your cash inflows, your costs rather, from the cash inflows that the project is going to generate for you. So if you are investing in, let's say you are investing in projects 1, project 2, and project 3. For project 1 is saying it will take you 2 years to recover your cost of investment. Project 2 is saying it will take you 4 years. While project 3 is saying it will take you 7 years. You as an investor, which project do you think you want to invest in? You want to invest in project 1 because it has a shorter payback period. Because you can recover your money that you're investing back quickly, faster than other projects. Also, payback period is not looking at the profits or returns you are going to realize from an investment. What payback period is only focusing on is what the period it is going to take you to recoup your cost of investment into a project. It's not looking at, okay, I'm going to realize 100% of my 100% of my investment back. No, that's not what payback period is looking at. So payback period is just looking at the period it's going to take you to recover your cost of investment. And the shorter your cost of investment, the shorter the period, the preferable is the project. And that is for what? A project that is what? I said a project will be undertaken only if the payback period is shorter or worse or equals to the maximum set standard. And for a single project, the payback period is compared to a set standard, meaning that you as an investor, you might set a standard that, okay, I'm investing this 5 million naira into a project, and I wish to recover this 5 million naira in the next 2 years or in the next 3 years. So by the time we carry the analysis of the project I'm investing into, it is saying that I'll recover my money in the next 5 to 6 years. Me as an individual, I would not want to invest in such kind of projects. So payback period is just focusing on what the period it will take you to recover your money. So for mutually exclusive projects, meaning that if you have more than one project, you're having 2, 3, 4 projects, you are going to what? You are going to rank the projects, and the project that is giving you the shortest payback period is the project that will be selected. So that is what payback period is just talking about. So it is different from accounting rate of return. Accounting rate of return is talking about what? The profits you can realize from your money that you're investing in the project. And it is usually expressed in form of what? Percentage. It is usually expressed in form of percentage. Accounting rate of return. The result is always expressed as a percentage. For payback period, it is usually expressed in terms of maybe years, days, months, or weeks, whatever. So that is the difference between accounting rate of return and payback period. If it is not clear, kindly call for help before I proceed. So I believe there is no question. I believe the explanation
Please,
is
sorry.
for
Can you
all of us.
explain again the accounting rate of return?
So I said earlier, accounting rate of return is you as an investor, you want to invest in a particular project. And what is going to be your goal is, what accounting rate of return is talking about is, what is the profit you are going to realize on your investment? What is the return for you that you are going to realize on your investment? I'm investing 1 million naira into a project. How much am I going to realize from it? This is my 1 million naira that I'm investing. How much am I going to realize on it? And it is usually expressed in the form of what? Percentage. Let me break it down further. I have project A and project B to invest in. I have 1 million naira with me. Project A is telling me that if I invest this 1 million naira into it, or let me say PiggyVest, I believe most of you are aware of PiggyVest. If you have PiggyVest and Access Bank, and you have 1 million naira, PiggyVest is saying if you invest your 1 million naira into us, you are going to realize 70% of your investment, which is 700,000 naira. That means your total money that you'll be collecting back is 1.7. But Access Bank is now saying if you are investing your 1 million naira, what you are going to be realizing as a return is just 60%. That means 1.6 million naira. You as an investor, which project would you want to invest in? Piggyvest or Access Bank? You would want to invest in Piggyvest because it has a higher rate of return, right? And accounting rate of return is always expressed in form of percentage. Your answer that you'll be getting will always be most times in percentage. That is what accounting rate is talking about. Is that clear? Hello, is it clear?
Yes, sir. Very clear,
Yes,
sir.
it is.
All right. And I've also explained payback period. And there's a formula for calculating payback period where your payback period is, where your cash flow is constant. It is just your initial cash outlay divided by your constant cash flow. That is where your cash flow is constant. That is constant that every year your cash flow will always be 5 million naira. Your cash flow will always be 5 million naira. That is where you can apply this formula. But when your cash flow is not constant, maybe for year one, your cash flow is 5 million, year two, it is 8 million, year three, it is 6 million. When you have a different cash flow, you cannot apply the tabular method. Do you understand? So that is that about payback period. So next we have the net present value. Net present value. What's net present value? This method refers to the equivalent in present value terms of the cash inflow and outflow from a project when discounted at a particular or given cost of capital. The appropriate discount rate chosen is the firm's or corporation's opportunity cost of capital, which is equal to the required rate of return. The decision criterion is that a project is acceptable if it has a positive NPV and rejected if it has a negative NPV. In total, the present value of cash inflows should be greater than the cash outflow. The positive nature of the net present value is presumed to be the potential increase in consumption made possible by the investment, valued in present day terms. Mutually exclusive projects will be ranked, and the one with the highest NPV value will be selected. Before I explain this, I believe you should understand what mutually exclusive projects means. It means if you are having more than one project, you have to do what? You have to rank them. If it is for payback period, if you have a mutually exclusive project, you will rank them. And the first one will be what? The selected projects. Same thing applicable to your net present value. Now, if you have a mutually exclusive project, you are going to rank them. But if it is a single project, you are just to determine that, okay, does this meet our specific goal? Okay, so let me explain. NPV is just used to assess your profitability on an investment by calculating the difference between the present value of your cash inflow and the present value of cash outflow over a specific period. In simple terms, it's just like NPV determines whether the value of your future cash flow discounted to the present value, whether it's going to exceed your initial investment, meaning that my future cash flow is 5 million naira. This 5 million naira now discounted to present. At this moment, how much does it worth? For example, you are going to realize 10 million naira in 2026. But that 10 million naira in 2026, you don't know what the economy will be saying by then. You don't know what the rate of inflation will be saying by then. So that 10 million naira that you are going to realize in 2026, you are discounting it to 2025. Today, to this period, at this moment, you are discounting your future cash flow to this present moment and calculate if it is going to exceed your investment, your cost of investment. That is what net present value is talking about. Is it clear? It is just net present value is helping you to determine if your investment will generate more value than its cost. That is what net present value is saying. And if you have a positive net present value, meaning that your inflow is greater than your outflow, the amount you're going to realize is greater than your cost of investment. That means you're having a positive net present value. Do you get the difference between net present value and accounting rate of return? Net present value, you are discounting a future amount to a present moment. That's net present value. Discounting a future amount to a present moment. That's what net present value is talking about. And if you're having a negative balance, that means that such investment will be a loss. So it is advisable not to invest in that kind of project. Also, let me just say this. Net present value is just like we are trying to talk about time value of money. We are trying to talk about time value of money. You know, time value of money is very important. You having 10 million naira today, the value of that 10 million naira as of today will not be the same in the next 6 months. I hope you are aware of that. The value of 10 million naira in the next 6 months will not be the same in the next 1 year. Am I communicating? So NPV is just used for what? To determine the time value of money. So that would be that for NPV. And you have your internal rate of return. Internal rate of return is also known as discounted cash flow yield. The IRR rate of return is the discount rate, which when applied gives zero net present value. And this is the formula shown on my screen. I believe when we apply this in a particular question, we are going to understand it more better. So, and also we have the profitability index. This is another investment appraisal technique which compares the present value of cash inflows with the present value of cash outflow in ratio terms. And the formula can be given below. The formula can be given as net present value of cash inflow over present value of cash outflow. The decision rule in profitability index is to accept every project whose profitability index is greater than 1 or whose profitability index is positive. In essence, accept projects if profitability equals to 1 or is greater than 1. Reject projects if profitability index is equals to 0 or less than 1. So, majorly, these are the major aspects that we'll be focusing on. But also, we are also going to be talking about cost-benefit analysis and cost-effective analysis. So I believe if I can be testing any question on investment appraisal, it must be on all this that we have discussed about. Just that, I can always twist the question. But if you understand the basis of each and every one of these method of investment appraisal, you should be good to go with any question that you'll be solving in the examination hall. So, and we are going to be looking at a series of questions tonight, which I believe, from my own perspective, solving the previous question that has been tested on ICANN will be beneficial, as well as sending you guys additional questions for your practice. So, I think I'll be opening the floor now for any questions before we proceed in solving questions. Any calculation, before proceeding solving calculation. Please, if you have questions on all these investment appraisal I've talked about, please let me know. Hello, can you hear me?
Please, can you explain the NPV again?
I'll believe that there's no question and we should
Yes, I can
proceed.
hear you.
Okay, you said I should talk about the NPV again.
Yes, thank you.
All right. NPV is just talking about time value of money. Time value of money. You are discounting a future cash flow to the present value. You are investing on a project and they are telling you that you are going to be realizing, for example, 5 million on this project in the next 5 years. You are in 2025, you are investing on a project and they tell you that by 2030 you are going to be realizing 5 million on this project. The 5 million you are going to be realizing on this project in 2030, you want to discount it back. You want to discount that 5 million naira to know the value as at today. If it is greater than your cost of investment. Am I communicating? That's just what NPV is talking about. The amount you are going to be generating in the future, you are discounting it to the present moment to know how much you'll be realizing as at today. So that's just what net present value is talking about. Is it clear?
Yes, thank you.
All right. So we have a series of questions showing on my screen.
Sir, please, can you come again with the IRR?
Sir, please, can you talk also about the profitability index? I'll be raising my hand.
Okay, sorry.
That is, can you talk about the mutually exclusive? That thing you're talking about mutually exclusive, please. I would really like to know more.
What is mutually exclusive?
Yes, you're saying something about mutually exclusive, not mutually exclusive. I don't really understand.
Okay.
Thank you.
So let me take the mutually exclusive part first. Let me start there. So what I'm trying to say here is, as an investor, you might decide that, okay, you want to invest in just one project. You have one project that you want to invest. That means you have just a single project you are investing into. You don't have any other project you'll be using as a comparison. Do you understand? But when you have more than one or two projects, they become mutually exclusive. And when you have a mutually exclusive project, for example, you have 4 projects, projects A, B, C, D, meaning that they are mutually exclusive. And you want to invest, you are trying to decide on which one to invest in. And your basis of investment is the payback period. That, okay, out of these 4 projects, which one is going to give me the shortest or the fastest payback period of the money I'm investing in? Project A is now saying it will give you are going to recoup your cost of investment back in 2 years. Project B is saying in 4 years, project C 6 years, and project D in 8 years. So it has become a mutually exclusive project. And in this kind of case, what do? You need to rank it. Because one thing about investment appraisal questions is, in the exam hall, you have to always make a decision. Your decision is going to carry mark. After solving a question, you don't just leave it. You are going to decide that, okay, it is advisable for Mr. Lagbaja to invest in project A. Why do you say it is advisable to invest in project A? Because it has a shorter payback period. So that's just the meaning of mutually exclusive. But when you don't have up to 4 projects, you just have only one project. That means it's just a single project that you want to invest in. So you don't have any other project you're using to compare. So that's the difference between a single project and a mutually exclusive project. So, and if you have a mutually exclusive project, you are going to do what? You are going to rank them. Do you understand? So that's that about that. So the next question, if I can remember, is internal rate of return. Internal rate of return, let me just put it this way, it's just like talking about the percentage rate at which your NPV of an investment or a project is going to become 0. Just trying to say that what is the discount rate that makes what? That makes your present value of your cash inflow to be equals to your what? To your cost of investment. What is that discount rate? That is what IRR is talking about. Is that clear? It's just saying, let's say the rate of return on investment will generate over its life, assuming that all cash flows are what invested at the same time. That's internal rate of return. Internal rate of return works alongside your NPV. Internal rate of return works alongside your NPV. And the last question is talking about profitability index. This is also an investment appraisal technique. I think it has been tested by ICANN once or twice, if I'm not mistaken. And this is comparing your present cash inflow with present cash outflow in terms of what ratio? In terms of ratio. That is what profitability index is talking about. And there is a formula for solving your profitability index. All what we are explaining in this written part, I believe well, by the time we start solving and we start applying the formulas, you are going to understand it more better. Also, please don't let us forget, there are still two types of investment appraisal, which is cost benefit analysis and cost effectiveness analysis, which, if time permits, we are also going to be talking about. But these 1 to 5 are the major aspects that has been tested by ICANN before. And if it is going to be tested in further exams, if investment appraisal will be tested in further exams, these are most likely what to be tested. And I've tried to analyze the questions that have been tested on investment appraisal, which you can see on my screen. And I'll be sharing this document after the exam, after the class rather. So if there's any question we could not lay our hands on, you can also go ahead to practice them. I believe if we're able to solve all these questions, or up to an extent, we should be fine with investment appraisal. Then we are going to be moving on to the next. And don't let us forget, public finance covers 30% of the syllabus. So we still have a lot under this section D. So let me start from the simplest to the hardest. I'll be starting with questions that will be easier for us before we go into the difficult ones. And please, I'm not going to be talking about the written aspects. You can see I've done the analysis, cost benefits analysis, what has been tested on it, written aspect has been tested, calculation aspect has been tested. And you can go and look at solve that on your own. So we'll be starting tonight, we'll be starting with November 2018 questions 4. November 2018 question 4. I believe you have the past question with you, the combined past question. Or should I share that on the group chat?
Yes, please.
Okay, let me share that on the group chat. Hold on while I do that, please. Okay, I've shared it on the group chat. So you can open it on your phone or on your system. But all I need you to just do is to listen attentively. I would also be splitting my screen here so that we'll be seeing the questions as we are solving. November 2018. So we'll be starting with November 2018 question 4. Please let me know if you can still see my screen or if you cannot.
Yes, sir. You are saying it.
All right, thank you. Okay, so we are going to be starting with question 4. So I read, Sampolopolo local government has identified a vacant land beside its marriage registry. The Director of Administration proposed that the land be used either for a cyber cafe where the general public can browse, make phone calls, photocopy, and carry out other computer services, or for construction of an entertainment event hall that can be rented out on commercial basis. So please, one thing about ICANN question is sometimes it can be voluminous, but no matter what, they just want to scare students. No matter how voluminous the question is in the exam hall, by the time you be in the exam hall in May, please, you don't need to be scared about it. All you need to do is just calm down and read the question, and you're going to realize that it is something that you know very well and you can solve. So yeah, they are telling us that there's a particular local government that has a vacant land beside its marriage registry building, and they have two options of what they can use the land for. They said they can either use the land for a cyber cafe for people to browse, make phone calls, photocopy, and carry out any other computer services, or they should use the land to construct an event center, an event hall, whereby they can rent it out for commercial basis, meaning that they have two projects that they can use this land for to generate revenue. So furthermore, they now said the idea was tabled at the council's management meeting and unanimously accepted. However, the Finance and General Purpose Committee recommended 5 years for the project. So that, what is that saying there? That is just saying that the number of years is 5 here. So take note of that. For the project, since the council secretariat building will be extended in future to accommodate more offices for the increased staff strength, and this was approved. So the question now went further to say that the cost of building the cyber cafe and event hall with necessary facilities and fittings, as well as the expected cash inflow or profits by the Director of Administration, are as follows. So yeah, they've given us the cost of investment, which is also known as our initial outlay, which is this. Our initial outlay for cyber cafe is 225,000. Our initial outlay for event hall is 300,000. Meaning that the amount we have to invest in cyber cafe is this, 225, and the amount we have to invest in event hall is 300. The residual value at the end of the 5th year is this amount, 20,000 naira for both of them each. And the cash inflows we are going to be realizing from both of them are also given. All figures assumed to be correct. Required as the consultants engaged by San Polo local government advise the local government on the more viable projects using what? Payback period and accounting rate of return, 13 marks. So your payback period is going to give you 7 marks and your accounting rate of return is going to give you 13 marks. So no thinking is required much here. So let us go ahead to solve. So what question are we solving again? Remember 2018 question 4. Please, I'll be sharing, you don't need to write, I'll be sharing this sheet with you guys. So you can always go through it. What's the name of the local government again?
Sorry, sir. Please, can you include the question, the number? Like, let's say
Which year
question
is this though?
sheet.
November 2018 question 4. November 2018 question 4.
Okay, you didn't drop it on the group. I thought it was on the group.
I've dropped the combined past question on the chat, so you can open it.
So I post November 2018, 2024 on your slide sheet.
On my what?
It's November 2018, 2024.
The sheet name. It's supposed to be
November 2018 question 4.
This is November 2018 question for now.
No, you wrote November 18, 2024.
Okay, thank you. November 2018, question 4. So the name of the local government is Sampolopolo. They gave us our number of years to be 5 years. And they asked us to calculate the payback period. And don't let us forget, we have 2 projects, which is what Cyber Cafe and Events Hall. Please, is my screen, is it bold enough for you guys to see?
Yes, sir.
Yes.
Thank you. So we are giving our year. Our year is given to be starting from 2012 up to 2016. Okay. So now, let's not forget, if you are investing in a project, I want to ask you guys this question, I want you to answer. You are investing in a project, and they said you are going to be realizing your profit or cash flow every year. So if you are investing in a project in 2010, when do you think you start realizing your profits? What year? Is my question
Following year,
clear?
2011.
The following year,
2011.
2011. Exactly, good. So if you look at the question now, they said our cash inflow will be starting from 2012. What does this imply? This implies that we are investing in 2011. Am I communicating?
2011. Yes, sir.
So that means you need to create a column for 2011. So that means we'll be starting from 2011. Is this clear? So do you know the reason for me writing 2011? So that if you are going through it again on your own, you won't be confused. We are investing in these 2 projects in 2011, while we start realizing our inflow in 2012. So that is why we needed to create this column for 2011. Is that clear? Is that clear, please?
Yes.
Yes, it's clear.
Yes.
All right.
Yes, sir.
Sorry, it's not clear. Oh, sorry, it's not clear. I'm sorry.
The reason why I created the row for 2011, the question says the number of years for this project is 5 years. And if you further look at the question, they said we will start realizing our inflows on this project in 2012. So if we are realizing our inflow in 2012, that means we must have invested in the previous year. And the previous year for 2012 is what? 2011. Do you understand? So you investing in 2011, that is why we needed to create this rule for 2011 as our year of investment. Is it clear now?
Yes.
Thank you. So we have our year for Cyber Cafe. We're going to have the cash slash inflows. Here we are going to have the cumulative cash flow. You can also call it net cash flow, any one of them. So in 2011, what is our cash flow in this question for cyber cafe? Who can tell me?
225.
Our outflow for cyber cafe is what? Is how much?
225.
225. That means 225 is what of the
Shell
pocket of
capital
the local government.
invested.
So that means 225. We are going to be having this in jackets because it is an outflow. Is that correct?
Capital invested, yes.
Okay, good. So
Yeah.
2012 is when we start realizing we have 90,000.
We have 90,000, 105, 120,000, 120, yes. 135, 135, then
and we
150.
have 150,000.
150.
Mr. Suleiman, you need to mute your microphone.
So our cumulative cash flow or net cash flow for 20 to 11 years will always be zero. Would always be what? Will always be zero. So for 2012 now, we invested 225,000 in 2011, and we've been able to realize 19,000. That means what? We want to know the outstanding balance. How much is left out there that we've not realized as at 2012, which is now the 225,000 minus
135.
90,000.
135. No.
That's already negative, so this one plus. So that will be giving us 105,000. Is this clear?
Yes, sir.
Okay. So
No,
we are
sir. Sorry, sir. Can you please take that again? Sorry, sir.
okay. You know, I'm using Excel, so that's why I'm having plus here. But if you are writing it in the exam hall, you know, you are just going to bracket your 225,000. If you want to press your calculator, you just say your 225,000 minus 90,000 will give you your cumulative cash flow. But in my Excel, you know, I'm using my Excel and formalize it, so I use it as plus. So that won't confuse you.
Okay, thank you. I'm clear now. It's okay.
Sir, please, I have a question.
Okay.
So I just put the 225,000 in brackets and then I did minus 90,000. It's giving me a positive 135,000.
No, it will not. It is going to be in brackets if you are solving.
Okay.
But if you want to press it on your calculator, it will be 225,000 minus 90,000, which will give you the balance that you are still having out there that you are yet to recover from your investment.
And that's what I'm saying. It's giving me a positive 135,000. But yours, I'm seeing negative 135,000.
That is what I'm saying. You know, this is already negative. So if
Okay.
you put it in jacket on your calculator, that means you are going to say plus 90,000.
Okay.
But if
Thank
you are
you.
pressing it directly, that's just 225,000. So now be 225,000 minus 90,000. But if you are saying minus 225,000, it is going to be plus 90,000 to get your outstanding balance.
Okay.
Exactly.
Yes, sir.
Yeah.
Thank you.
So that means that as at this first year, we still have 135,000 naira that we have not recovered. Do you understand? So, but then I said in 2013, we realized 105,000, which will give us this
45,000. 45,000.
30,000.
32,000.
Please
It's
look at
minus
it.
30,000.
Minus 30,000. That means the amount we invested, we are still having 30,000 naira out there that we've not recovered, right? Okay, good. So for the following year too, we are also going to apply the same method.
Then we have 90,000.
Exactly. The following year.
Positive 90.
2015 will be 225.
Exactly.
Yeah.
So I also want to call your attention to something. They said this we also have a residual value of 20,000 naira.
Yeah.
So residual value will always come in at the end of the year. That means we are
Okay.
also going to be having another 2016, which we are having a residual value of how much? 20,000 naira.
Okay.
Do you understand? So that's where it will come in. The residual
Yep.
value will always come in at the end of the year. So totaling 395,000.
Your screen is not coming up, sir.
That should be your network, please. I believe others can see my screen.
Yeah.
Yes.
Yes, sir.
Yes.
So cyber cafe, we are solving based on payback period. And like I explained earlier, payback period is talking about what is the period it is going to take us to recoup our cost of investment. So based on this question, as at the second year, which is 2013, we still have 30,000 naira out there, right?
Yeah.
But as at 2014, which is the third year, we're having a positive of 90,000. That means we've been able to recover our balance of 30,000 and we've been able to realize a profit of 90,000 also at the moment.
90,000.
Meaning that it took us 2 years and some months to recover this 225,000 naira that we invested. Am I correct?
Yes.
So, but we don't know the exact month it took us here, right?
That would be 30,000 divided by 120
We are going to get there.
times 12.
We are not seeing this.
You are not seeing my screen.
We are seeing the screen.
We can see the screen now. We can see the screen.
Can I ask a question, please?
Proceed.
Can I ask?
What's your question?
Sorry, I skipped. I didn't want to disrupt you when you were doing that thing. This our 225,000 naira.
Okay.
How are we getting this minus 135,000, please? I didn't want to start with you.
Okay, how did we get to minus 135,000, right?
Yes, like it's not doing in my side.
What are you getting on your side?
I'm getting a positive value. Then if I add the minus, I'll be getting 315,000 naira.
Okay, I explained that earlier. Don't forget, your 235,000 is a negative balance.
Okay.
So you can solve it two ways. If you are pressing minus 225,000 naira on your calculator, it is going to be minus 225,000 plus 90,000.
Okay.
Plus 90,000.
Yes.
If you say minus 225,000 minus 90,000, it will come it up. It will give you 370,000 plus. Minus times minus, we give you plus. Do you understand?
Yes.
Exactly. So if you are saying minus 225,000, it will be minus 225,000 plus 90,000.
Yeah.
But if you are just pressing the 225,000 direct, it will be 225,000 minus 90,000, which will give you minus 130. Understand? So we've solved for cyber cafe. Now we are going to solve for Eventor. So I don't think this one should take us time. Just apply the same understanding we have on it. So this is the same thing. So looking at the event on now, as at the first year, 2012, we still have 150,000 out there from the cost of investment. But as at 2013, which is the second year, you can see that it's showing a zero balance, meaning that we are able to recover our 300,000. So this is pretty straightforward, meaning that for events all, it took us exactly 2 years to recover our cost of investment. The payback period for event all is exactly 2 years to recover it. Is that clear? But
yes.
For Cyber Cafe, but for Cyber Cafe, it is 2 years and some months in the third year, which we don't know the number of months. So we are now going to solve for that. Do you understand? So to get the exact number of years it took you for cyber cafe, I'm going to say the number of years
divided by
plus negative balance here we're going to be having multiplied by 100. So number of years plus negative balance divided by your actual cash flow. Let me put a divide sign here, or better still, let me just write it there. Divided by actual cash flow. Multiply by 100 over 1. So this is what is going to give you the exact month it took you. So in this question, what is our number of years? Number of years
2
is
years.
2 years, right?
2 years.
We are
2 years.
it's 2 years. So we are trying to get the months. 2 years plus what is the
30,
negative balance? The negative balance
30.
as an estimate is 30,000, right? So
Yeah.
2 years plus 30,000 naira
Divided by 120.
divided by
55,000.
120
120.
multiply by what?
12 months.
Because how many months do we have in a year? It's 12, right?
Yeah.
So that's it. So we are going to be applying this formula now. Let me formularize it. Equals to 2
Plus
plus bracket 30,000 divided by 120
20 times 12.
multiplied by 12. Please. No, I'm using my Excel, so I need to formularize it very well.
So sorry, we are using the 2 years because we have 30,000 as the second year. So if we are to have a third year negative balance, are we going to use 3 years?
Exactly, you'll be using 3 years.
Oh.
Using 2 years.
Hello, sir. Hello, sir. Please, where do we get that 120,000, sir?
2014.
So it's just the formula that we are following. The formula says, we want to get the exact month it took us to recover this 30,000 in the third year. That is what we are trying to get. Because if you look at the third year, we are having a positive of 90,000, meaning that our balance of 30,000 naira, which is our cost of investment that we have left as at year 2, we are able to recover it in year 3 and also have a profit of what? 90,000 in year 3. So 2 things occurred in that third year. We are able to recover our cost of investment, and at the same time, we are able to make profit. Do you understand? So that is where the 120,000, which is our what? The cash flow for that year 3, that is where it's coming from. Is that clear?
Yes, thank you, sir.
Hello, sir. Good evening, sir. I've been raising my hand.
Okay, proceed, please.
Okay. I get I've been following up, but at this point where we are solving for the last, the competition of our final answer. Please, can you take it again? I think I have not really gotten it.
Okay, from where I inserted this formula, right?
Yes, sir.
Okay, let me take it from here. If you look at our solution here, events on, we invested 300,000, and By the time we started solving, year one, 2012, they said that the inflow is 150,000, meaning that out of the 300,000 we invested, we are able to realize 150,000, which means that we have a balance of 150,000 as our cost of investment, right? So as at year two, they said the cash inflow was also 150,000, meaning that it has been able to net off our balance of 150,000 naira, our cost of investment, meaning that it took us 2 years to recoup the 300,000 naira that we invested into events hall. No, we are dealing with payback period here. It took us what 2 years, which is year 2012 and 2013, to recover our cost of investment in events hall. Do you understand? Because if you look at the second year, here we're having a zero, meaning that all our 300,000 naira has been recovered at exactly the second year if we are investing in event hall. But if we are investing in cyber cafe, as at the second year, which is 2030, we still have a balance of 30,000 naira to recover. You understand? We still have a balance of 30,000 naira to recover.
Yes, sir. Yes, sir.
So as at the third year, you can see that it changed to a positive of 90,000. That means as at the third year, we are able to recover our outstanding balance of 30,000, which is our remaining cost of investment into the project. And at the same time, we are making a profit of 90,000 naira. But the total inflow as at that year was 120,000 naira. So two things occurred in this year. We recovered all our cost of investment, the balance for our cost of investment, and we also made a profit that same year. So that means we are trying to figure out that how many months did it take us in that year three to recover this 30,000 naira that we have left in year two. Am I communicating?
Yes, sir. Yes, sir.
That's what we are trying to get here. And to get it, that's when you apply this formula. And the formula is your number of years plus your negative balance divided by actual cash flow. Your number of years is 2 years. As at the second year, that's when we're having a negative balance of 30,000. Plus, what is your negative balance? 30,000. And what is your actual cash flow that you realize in 2014? It's 120,000 naira. Multiplied by 12, which is going to give you 2.25. So meaning that it took you 2 years and 2 months, or let's say approximately 2 years and 3 months to recover this total of 225,000 that you are investing in cyber cafe. Meaning that in 2014 year, it took us 3 months to recover this balance of 30,000. I don't know if that's clear enough. If my
Yes,
explanation
sir.
is
Thank you very much. It's very
so
clear.
that's just it. So approximately it took us 2 years, 3 months to recover our investments in cyber cafe. But for event hall, it took us what exactly 2 years to recover the 300,000 that we're investing. So you as an investor, you are now going to decide which of them is giving you a shorter payback period. Based on what we've solved now, event hall is giving you a shorter payback period.
Defense.
To invest in Investor. And they said required as the consultant engaged by San Polo local government, advise the local government on the more viable projects using payback. So for your investment appraiser, please don't always forget you are also going to carry out your decision. Your decision. It is very important. Maybe that's 1 mark. So you can now say it is advisable for San Polo to invest in events hall. Why is it advisable to invest in event hall? Because it has a short payback period. So that's your decision. That'll be your decision. Please note, your decision is always very important when solving investment appraisal question. Please take notes. So that will be all for the payback
Oh,
period.
sorry, please, can I
Sorry,
have
sir, please, I have one question, sir, please.
Okay, what's your question?
Okay, the calculation we just did, from the formula, we have times 12. But for you to get this 2.25, we didn't make use of the 12, which is 12 months in a year. So I don't understand why it's in the formula when we did not make use of it, sir.
On your calculator, you said the 12 months is not giving you the figure.
No. From when you calculate it, 30 divided by 120, you have 0.25. Then plus the 2 years in front, that's 2.25. We didn't make use of the 12 months at all to get this 2.25.
Hello, sir.
Hello, I'm with you.
Also, the
I'm here. If you get my question, sir.
100%, we did not make use of that or times 100.
You didn't
Based,
make use of yes. Why is it
based on
there?
what she
That's what
based on what she just had now, based on the question she just asked now, we did not also make
Times
use of
100 will
that
not be included.
100.
Yes, because when you do 30,000 divided by 120, you have 0.25. Then if you add 2 years, that's the number of years, you have 2.25. Meaning, I don't know, maybe I'm missing some. So you did times 12, we didn't apply it, and we also did not apply the times 100.
No, it's
I
not
don't
times
know.
100. I wanted to write times number of months. Thanks for the observation.
Okay. Then the 12, sir, the 12, we didn't make use of it too, and it's in the formula.
Hold on, please. Supposed to be included. So I'm using my Excel here. It can't be giving 5 years.
If you do 30 over 120,000 times 12, you get 3 months.
That'll be 5.
I think I got 2 years 3 months.
I also got 2 years, 3 months.
Did you include the
Yes. Yes, with
months?
the formula. Yes, with the formula that I gave us, 2 years 3 months.
Times 2 years and 3 months with the formula.
Yes, 2 years, 3 months.
You do 30 divided by 120,000, you get 0.25. Then times the 12 months, you get 3 months.
Yes. Yes.
Please, maybe you should tell them how you press the calculator.
So, sir, I think you need to apply board mass.
Exactly, board marks. You do your multiplication first, then your addition
Yes.
after.
Was 30,000. Am I not getting this?
So you do your multiplication first, then with the then you add your 2 years to it.
Then add your 2 years to it.
All right, thank you. That's 3. It has approximated already, giving us 3 years. So is that clear? Can we proceed, please? That is fast, please.
Sorry, it's not clear. I'm getting 5.
Wow.
Oh.
So even me too, I'm getting 5. We are not adding that 2 years.
Yeah, you're not adding the 2 years because
apply the formula for board mass. Do your multiplication first.
We are not supposed to add the 2 years. 2 years stand on its own. Then the other calculation is for the months. So
Exactly.
it's just
We're
2
only looking
years,
for the
3
months.
months.
It's the
Yes,
months
yeah.
we're looking for, not the year. We already know that it's 2 years already. So it's the months that we're looking for now, which is 3.
2 years stands on its own.
Okay, thank you. Yeah, thank you.
All right, so we'll be proceeding to account rate of return, please.
So, sir, I want to ask a question before you proceed.
Okay.
So, this payback period doesn't consider whether investment A, would pay us more compared to investment B. It only focuses on the period when we're going to recoup our investment, correct?
Exactly.
Okay.
I said it in my explanation that payback period does not talk about maybe your profit or whatever. It's just talking about the period it will take you to recover your cost of investment.
Okay. Thank you.
All right. So the next question is solve accounting rate of return. So for your accounting rate of return, you can use your table method or the formula. So I'll be using the both in this question so that you can choose the one that will be better for you on the long run though. So I'll start with the table tabular method first. You need to be very fast, please. Time is fast spent. So I said in my explanation that accounting rate of return is just focusing on the profit you are going to realize on your investment, and it is usually expressed in terms of what? In terms of percentage. So good. In this question, don't let us forget also, in the note I gave, I said you can solve your accounting rate of return using this formula: average accounting profit over average investment. But there's also a formula to get your average accounting profit and to get your average investment. So which we are also going to be applying all this in this question. So for the tabular method, you have your cash year, your cash outflow, your depreciation, your accounting profits. Here, you don't need your year of investment. You don't need your year of investment. What you are focusing on here is your profits on your investments, which is usually expressed in terms of percentage. So we have our cash outflow here, we have our depreciation, and we need to get our accounting profits. We need to get our accounting profits. So, but to get our accounting profits, we need to get depreciation because we have to get our accounting profit. It will be your cash outflow less depreciation will give you accounting profits for all the years. So, and the formula for depreciation, I believe, is not new to you guys, which is what? Cost minus scrap value over number of years, right? Cost, please, I need to do this one fast. Scrap divided by n. And in this question, what is our cost? 225,000, right? You guys are not responding. What's your cost in this question?
225.
225 or 7.
What's our scrap?
1,000.
20,000, right? Divided by number of years.
Please, that person should kindly mute.
All right, correct. So that means our depreciation is 51,000 naira, which is what we are going to be using here for the whole years. So to get your accounting profit is not difficult. That will be equals to this minus equals to cash outflow minus your depreciation for that year equals 49,000. That means our total accounting profit is what? 395,100 naira, 295,000. So we've been able to
Please,
get our.
please, I have a question.
All right, go ahead.
Okay, please, for this ARR that we are solving,
okay,
you wrote cash outflow. I thought on the question those figures are inflow.
Sorry, that's a cash inflow. No, I just copied and pasted those that table, so that was why. It is your cash inflow. Thank you for the observation. I'm trying to save time, so I copied the table. So these are your cash inflow, these are your depreciation, and this is your accounting profits. So this is your total accounting profits. But don't let us forget, we said we need our what? Our average accounting profits. And in the note I gave, I said your average accounting profit is what? Your total profit over number of period. So to get your average accounting profit now,
Sorry, I want to ask a question before we move further.
okay?
Hello, can I ask? Okay, the
Yes, go ahead.
depreciation. Sorry, I'm not. The depreciation. Where did they get the cost from and the scrap value? Because I'm looking for it, I'm not seeing it.
Okay. So initial cash outlay is your cost. It's also the same thing as the cost of investment. Your initial cash outlay is also the same as the cost of investment. The amount you are investing into that project. You understand? And you have residual value. Another name for residual value is scrap value. So if I did not call it scrap value, I can call it residual value. So this divided by this, 225 divided by, it is formularized already, so I can give it to you. I'll
Sir,
give it
I
to
have a
you.
question, sir.
I was going to ask, sir, please, will you share this Excel sheet with us?
Yes, I will.
Thank you.
So
sir, please, shouldn't, if we don't have the residual value, what will be our accounting profit? Is it the normal?
That means it will be zero. Your scrap value will be zero. Just be cost minus zero divided by the number of years.
Okay.
Yes. So with this, we have been able to get our total accounting profit. Our total accounting profit will be 395,000. But in solving your accounting rate of return, what you need is your what? Your average accounting profit. And the formula for average accounting profit is what? Total accounting profit divided by number of periods. And just write it at the front here. Total accounting profit over N. So what's that going to give us? That would be 395,000 divided by 5. So that gave us 79,000 naira. Exactly. Is it clear?
Yes, sir.
So that means solving your accounting rate of return, the formula says ARR equals average accounting profit divided by average investment times 100 over 1. So for your average accounting profit, we've gotten that. We've gotten that one to be 79,000 naira. So what we need to get here is our what? Average investment. And to get your average investment, it is what? Initial investment plus scrap divided by 2. So let us solve for average investment now. Initial investment plus scrap divided by 2. So that will be equals to 225,000 plus 20,000 naira divided by 2. So your average investment now is 122,500 naira, which is our initial investment. What our initial investment? Our cost of investment 225,000 plus our scrap. What is our scrap? 20,000 naira divided by what? Divided by 2. So that will give you what? Average investment. Then after having your average investment, that means you can now solve for your accounting rate of return, because the variables that you need You have gotten it already. So to solve your ERR now, the formula says what? Average accounting profit. What's our average accounting profit? 79,000 divided by average investment, which is this. Let me put it in brackets. Multiply by what? Multiply by 100. So that will give us 64.4 blah 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 percent. So let me reduce this. So that means your accounting rate of return is 64.49%. So that is for what? That is for cyber cafe. So we need to solve for events all so that we'll be able to do what? We'll be able to compare. We'll be able to compare. So for this, I need to be fast about it. Our depreciation. We are investing 300,000 naira, right? If I can remember clearly. Our scrap is 20,000. So I won't spend much time on this. Divided by 5. So it gave us our depreciation to be 56,000 naira. So our depreciation here is 56,000 naira. So your accounting profits, that cash inflow minus depreciation. So don't let us forget, these are our cash inflow, not outflow. So total of this is giving us, total accounting profit is giving us 110,000. But we need our average accounting profit. Don't let us forget, please. So I won't be spending much time here. To get your average accounting profit is total accounting profits, which is 110,000 divided by 5. That gave us 22,000 naira. Then your average investment now. I believe what I'm doing here is clear. It's not magic.
Yes, sir.
All right. So our initial investment is 300,000 plus 20,000 divided by 2. So that gave us 160,000 naira. Then you can also give your ERR. So the formula is your average accounting profit divided by your average investments multiplied by 100. So that is giving us 13.75. You as an investor, if you are seeing this kind of rates, that if you are investing in cyber cafe, your 225,000 will be giving you 64% returns, while your 300,000 will be giving you 13.75%. You as an investor, which one will you go for? Cyber cafe or event hall?
Cyber
cafe.
That's where your decision will now be. It is advisable for Sampolo to invest in cyber cafe. Cyber cafe, because it has a what?
It has 64%.
High return on investment.
Higher return, yes, higher return on
Return,
investment of
higher return on
64
investment, higher rate
or
of return, anyone. So that's that about it. So we've been able to solve this question now, and we've been able to get to 20 marks on that particular question. So that's that about payback period and accounting rate of return. Payback period is focusing on the period it will take you to recover your cost of investment. The shorter the period, the better the investment you are to go for. Do you understand? While for accounting rate of return, it's talking about how much you are going to earn on your cost of investment, but it's usually expressed in form of percentage. So if you're in the exam and you're solving for payback period, the answer you should be seeing is like maybe 2 years, 3 months, 3 years, something, 5 years. For accounting rate of return, it should be seen percentage. You understand? So that is when you know that yes, you're on track. So that will be all for these 2 questions. I think we should be able to solve one more question. Let's try if we can solve one more question. And if you cannot finish it, we are going to end here to call it a day. Because I think time is fast spent. Okay, also I said something that there's formula to solve all this. If you don't want to go through this tabular method, if you don't want to go through this tabular method, should I show you that or I should just move to the next question?
Sure, sir.
Sure, please.
Okay.
If we can apply it, if we can use it in examination hall.
Okay, the formula method now. Accounting profit. So in this scenario now, your accounting profit, what you are going to arise is your total cash inflow is what you'll be recognizing as the accounting profit. You know what in this first one, this tabular method, what we recognize as accounting profit is this 395,000, right? But for the formula method, what you realize as accounting profit is your total inflow, which is giving us this 600,000 naira. Okay, let's bring it down. Accounting profit is saying 600,000 naira. Then you saw the accumulated depreciation. Here will be accum dip. So to calculate your account depreciation here will just be your cost of investment. This 225,000 naira minus 20,000 naira. That will be your account depreciation. So then you're now going to say your accumulated profit minus account depreciation. You can see that it is also giving me this 395,000 naira. The 395,000 that we recognize here. Can you see it? That is what I'm also getting here. So meaning that you don't need to be passing through the stress of just drawing this table and doing it one after the other. If you can just sum all your cash inflow on your calculator and you're able to realize it, I'm just going to say your cost of investment minus the scrap. Then whatever you get, use it as your accounting profit. Then you can now solve for average investment and solve your accounting rate of return. That's just it. So you don't need to be drawing the table or anything. Just pass through this method. This is just like a shortcut also. Do you understand?
Yes, sir.
Exactly.
So I have a question. Yes, sir.
Yes, sir. So please, I have a question.
Okay.
I think when we are talking about accumulated depreciation, it should be the depreciation for the 6 years, not just one. And the depreciation you wrote is just for the 6th year, which is 20,000.
Come again.
I think when we are talking about accumulated depreciation, it should be depreciation for the 6 years, not just for 1 year that they gave us 20,000.
Okay. Is that all?
Yes, sir.
Okay. What you are seeing here is this 205 is also the depreciation for the 6 years. Because what I did here was the cost of investment minus the scrap value, which gave us 205. If you look at what we did in this tabular method, If you sum all these up, how much is it giving you? You can see that it's also giving you, I see where my cursor is. It's also giving you 205,000 naira. Is it clear? The sum of all this depreciation that you've solved one after the other year, it is giving, let me sum it up for you. Can you see this?
Sorry, just to add, what they gave us in the question is the residual value, not the depreciation value.
Not depreciation value, is your residual value.
You understand? It's the residual value. That's after charging the depreciation. What will
What is remaining
the
left?
worth of the assets after the useful life is 20,000. So that what they gave us in the question is just the residual value, not the depreciation amount.
So whoever asked that question, is that clear?
Yes, sir. Thank you, sir.
All right. So that will be all for payback period and ARR. So this is already 10:46. Let's try to take another question and see if we'll be able to finish on time. And wherever we stop, we'll call it a day there. So let's solve May 2019 question 7. I think that question should be a cheap one that we can solve it.
Sir, please don't forget to share the class.
Yes,
the sheet.
definitely. I'll share it.
And
So
then
this
video is
question,
recorded, right?
yeah, sure. So question 7 now, November 2019. So if I'm to read the question, now they say, A, distinguish between net present value and internal rate of return and state the decision rule under both criteria. Okay, good. This is pretty straightforward. And they gave it 8 marks. Please, I want to call your attention to something. When you see some question like this, and you see 8 marks, and you see question like this, and you see 2 marks, what you expected to this totally different. A question like this that is carrying 8 mark, you need to write all you know about it. You understand? You cannot expect that what you're going to write for this question that is carrying 8 mark, you cannot write it for a question that is just 2 marks. Do you understand? But for these 8 marks, the marks attached to a question also, please always be careful of it. In this kind of question, what do? You define NPV, state the formula, state the decision criteria, you define internal rate of return, state the formula, state the decision criteria. All you know about the both of them, make sure you write it. Everything you know about the both of them, just make sure you write it. Do you understand? Make sure you write it. Make sure you write it. Everything you know about them, because this question is carrying 8 marks. You cannot just put 8 marks to this question and they don't expect you to write. You must always write something, please. It's very important. So the B aspect, because of our time now, they said 2 projects, A and B, have initial capital investment of 900,000 each. That means project A, the cost of investment is 900,000. Project B, the cost of investment is also 900,000. Then I wait for that to say. The cash inflows of the 2 projects are given as follows. So they've given us the cash inflows of the 2 projects. Project A, the cash inflow for year 1 to year 6. Project B, the cash inflow for year 1 to year 6. And I said, as a financial analyst, calculate the net present value of the 2 projects. Of the 2 projects given. And you have to use, okay, of the 2 projects, given a cost of capital of 12%. So they've given you the cost of capital to use, they've given you the inflows, and they've given you the cost of investment. So now let's go. What's the name of the company? Okay, we are not giving the name of the company. What should we use as the name of the company?
Joseph's company.
Apex company, I mean.
Joseph.
Yes, sir.
Let's use a
Yeah,
pen. Security
that's
limited.
my company.
Okay. So let me split my screen, please.
Yeah.
Mute your mic. You have the year. You have project A. We have project B. Okay. This is what's our discount cash flow given in the question? Which is our cost of capital.
12%.
12%.
12%. Then you have your cash flow and you have your present value. Who can tell me the explanation I gave regarding NPV when we started? Who can tell me? Nobody.
Okay, so you said you're trying to um get the present value of a future value that has already been given.
Exactly.
If
So
like
you are trying to get the money in present value. So they gave us 6 years, right? For your NPV is just like the way you solve your payback period. You are going to be starting from the year of investment, which in this case will be 0. Then we have year 1, year 2, year 3, year 4, year 5, year 6. So we have 6 years. So our cash flow for project A, they gave us 400,000, 500,000, 100,000, 225,000, 105,000, and 150,000. Is that correct?
No, that's wrong.
Okay, hold on. So yeah, year 0 is our year of investment, right? And we are investing 100,000 naira. So I believe in solving your DCF, you still remember the formula. For those of us that cannot remember, the formula is just 1 plus R close bracket raised to power minus N. So that's what we are going to be applying here. You can also press it in your calculator. So this is our year of investment. This is the amount we are investing for both years, for both projects rather. Let me move this. Let me where they are gone. Then we need to calculate our discounting cash flow. So this is what we are using to discount it to present value. 12% is what we're using to discount this 400,000 naira to present value. Is that clear? So now we are applying to the formula for year 1. The formula will now be 1 plus 12% is 0.12, right? Raised to power minus 1. Raised to power minus 1. So that's giving us 0.8928. Then we're also going to apply the formula for year 2. For year 2, it is now going to be raised to power minus 2. Year 3, you apply the same formula, raised to power minus 3. Year 4, you apply the formula, it will be raised to power minus 4. Year 5, apply the same formula. Is per minus 5. Then year 6, apply the same formula. Is per minus 6. Then you multiply because you are discounting to the present value. That will be your this year multiplied by the cash flow. It's giving us this 357142. Then we bring it down. Like one. Please let us always maintain 4 decimals after the point. Okay. Thanks. The total of the present value now. Total of the present value now is 141,000. Discounting it now. So that's for project A. Then we have to solve for project B also the same way. We have to solve for project B.
Excuse me, sir.
All right, go ahead.
Sir.
I'm listening.
Sir, can you please remind me how to realize the discounted cash flow? Can you?
Okay.
Using the formula.
That is what I pressed in my calculator. That's what I am displaying here. This year, it is 1 plus r raised to power minus n. 1 plus rate, and the rate given here, your r is what? Is 12%, which is 0.12. So if you look at my formula here, I said 1 plus 0.12 raised to power minus 1. That is for year 1. For year 2, same formula, 1 plus 0.12 raised to power minus 2. Year 3, same thing, then you apply it like that. So after getting that, you multiply it by the cash flow, then you now get the present value. Meaning that for this 400,000 naira, the present value for 400,000 naira is this amount, 357,000 naira. The present value for this 500,000 is 398. Do you understand? Like that. So we are now solving for project B. We have 250,000, 350,000, 250 again, 150, and 200,000, 75,000. So your present value now be, so I still be maintaining this. So your discounted cash flow multiply by your cash flow. So this is giving us this.
Sir, for the 5th year, is that 200,000 or 2 million?
Okay. This is 2 million naira. Thanks for that. So you solve for the present value. Based on this solution, what do you think will be your decision as an investor? So what will be your decision as an investor?
To go for
To
project.
invest in project A.
To invest in project A. Why?
because it's
Because it
giving
has a higher present value.
exactly.
It is advisable for Apex Limited to invest in projects A because it has a higher net present value. So that will be our decision for MPV.
Please, I want to say something.
All right.
For the first one, project A, that's year 2. What I have was supposed to be 398,600.
398,600.
Yes, that's what I had.
Is this not also 398,600? If you approximate it, this 5, it's turned to 6. The 9 will turn to 0. It's just approximation.
Okay.
Just approximation. So I think we were able to maximize our time tonight, at least to some extent.
Sir, please, I have a question.
Okay, go ahead.
So my
I
question
also have
is,
a question.
is there an explanation for why the N in calculating the discounted cash flow is in negative? Like, is there an explanation for that?
Okay, okay, why it is in negative, right? Why it is minus N?
Yes, sir. Yes, sir. Yes, sir.
Yes, it is because we are discounting future cash flow to present. Assuming we want to discount present to future, this minus wouldn't be minus. It should just be raised to power N. That is if we are discounting present to future. But if you are discounting future to present, it will always be minus. It will always be minus. Do you understand?
Yeah, thank you so much.
Okay, so I also have a question.
All right.
Okay, my question is based on the previous one that we did. Okay, in a situation where you don't have a residual value and you're meant to determine the average investment, I've seen a question where they solved and to calculate the average investment, they divided by 2. And I've also seen a question where they divided by 1. So I don't know which one should we go with.
No, the average investment you always divide by 2. This is the formula. Formula is given in your notes here. Your average
So whether
investment,
we have residual value or not, we are dividing by 2.
yes, you're dividing by 2. You're dividing
Okay,
by
sir.
2.
Thank you.
We call it average. And what does average mean? Average means half. You
Yes.
understand? So you always
Yes.
divide by 2.
Okay.
You always divide by 2.
Okay, thank
So
you.
any other question? So if there's no other question, I think we'll be calling it a day. I'll be seeing you guys every Sunday. So we'll be meeting next week Sunday. We would also be solving some questions on investment appraisal because we need to wrap it up. We need to wrap up this topic, and I don't think we've solved enough questions because these are just little questions. There are still some technical questions that still need to be solved on investment appraisal. So we are still going to be solving. So I think next week Sunday should
Sir,
be for us to finalize it. You want to say something?
yes, sir. What I want to say is this: the IRR, that is internal rate of return.
Yes.
Can you just explain because it's a further of MPV? Can you just
Yes.
explain so that we know that we have stated that?
Okay, I said it earlier. I said IRR works alongside MPV.
Yes, sir.
Yes. So internal investment, internal rate of return is just like talking about what is the percentage rate at which your NPV is going to be 0. Meaning that you want to know the discounting rate that makes the present value of your cash inflow to be equal to your investment. the amount you are investing to be equal to your what? To your inflows. The rate that will give us this is what we are trying to, which is in our IR. And there's also a formula to it. There's a formula for solving your IR, which I've also included in this material. I've included it in this material. Your lower rate plus your positive NPV divided by your positive NPV and negative NPV multiplied by higher rate minus lower rate. We're also going to solve question on this IRR because I think rather, if they will want to test question on investment appraisal, it should be on IRR or NPV, both of them. But we are going to be solving question on this by next week, God's grace. Next week, God's grace.
Okay, sir. Please, the second thing I want to ask. Hello.
Okay, I'm listening.
Hello, sir.
Hello, sir.
Okay.
So, the second question I want to ask is that this one that we did is not maybe from 0 to 5 years. You understand what I'm saying? That is, the year is 1, 2, 3, 4. If it's going to be 0 to 5 years, how are we going to go about it? Especially the formulas.
Guys, this is past 11.
Sorry, please, let's just take this question. Hello.
Sir, please, before
Yes,
you go,
sir.
please, can you share this Excel?
Yes, I'll share it.
All right, thank you, sir.
And also, sir, don't forget to send the.
Hello, can we get how can we get
Yes.
the material? Sorry, please.
I will send it on the group chat.
Okay, thank you.
Thank you very much for the class. So it's a very interesting one.
Thank you
God
so
bless.
much, sir. God bless you.
God bless you, sir.
Thank you so
Thank you
much.
very
Yeah.
much, sir.